I would now like to invite our CEO panel on the stage, Mr. Ahmed Nasef, Fidelity United, Mr. Jason Light, Emirates Insurance Company, Mr. Neelmani Bhardwaj, Takaful Oman, Mr. Owais Ansari, Munich Re, and Mr. Parvaiz Siddiq, Salama.
First of all, thanks a lot to our panel for taking the time out. Being a CEO is one of the most jobs in an insurance company. And I mentioned this in a previous conference as well, that you have to be a magician because you have to keep the people below you happy. You have to keep the shareholders happy. Then at the same time, you have to keep the regulator happy and the market happy. So it's a very difficult juggling job. So I wanted to start off initially just to hear from all of you. One sort of a positive thing that you've seen happening in the industry maybe over the past year, and one sort of negative thing that you've seen happening in the industry over the past year.
Well, thank you very much, Hatim, and very nice to see you all again, my friends at BADRI and everybody here. Thanks for inviting me. I was thinking about this on the long journey up from Abu Dhabi. It's a short journey until you get to the border of Dubai, and then the traffic sort of takes over. Maybe the one bad thing is the traffic has got worse in Dubai in the last year. It's not a particularly insurance-related point. I think on the negative side, and just really following on from the last presentation, I think that a real cause for concern for me is actually the explosion of MGA capacity that we're seeing. I think, and I don't want to tar everybody with the same brush. Of course, there are MGAs who are specialists in particular areas and are bringing, expertise to the market and very specialty products that perhaps don't exist or are not very developed in the region. That is certainly, to be welcomed. But I think, to be frank, on the whole, the explosion of MGA capacity is not that. It's an explosion in core product areas. And I don't see that as a positive at all. And I'm afraid I disagree really with much of what the previous speaker was saying. I'm a A- rated company, so I'm in the happy position, happy strictly in inverted commas, of receiving regularly requests to participate in MGAs, to be a capital provider for MGAs. And also, we're obviously a considerable buyer of reinsurance. So we're having two MGA conversations quite a lot in our company. And they're two very different conversations. If you're being requested to become a capital provider or a capacity provider, the emphasis is on how easy it is to get in and out, the low barriers to entry, and don't worry about anything, we'll take care of everything with our $30,000 capital. And then when you're buying reinsurance from the same people, they're saying, well, our capital providers are A+ security, nothing wrong with them. We've got different covers for different parts of the business. Often different products have different reinsurers behind them. But you don't have to worry about that, also on the back of our $30,000 capital. Now, I think the dichotomy of those two conversations is something that gives me quite a big cause for concern. Now, some, as I say, and I don't want to tar everybody with the same brush, but some MGAs will make it and will bring something positive to the market. But I suspect many will not. And as we're going into, and they're, participating in this softening of the market, as we go into a softer market, are we going to be, as insurers, as their clients, reliably going to be able to collect our claims from them if those claims do occur? Now, maybe the answer to that is yes, eventually. But I think the growth of that sector of the market, with quite an unclear, for me anyway, chain of security and reliability of security is a cause for concern. And in the meantime, before we have that big loss, which we may or may not be able to collect, they will contribute to a further softening of the market. So that, for me, I'm afraid, despite what our previous speaker was saying, is a real cause for concern. I think on a more positive note, I think that with one or two exceptions, the way that the market responded to the unprecedented Dubai flood claims and has returned to some prosperity, as we've seen in 2025, is something that we should all take some pride in. So I certainly see that as a positive.
Good afternoon. It's interesting for me coming to the market after almost 5 years of absence and trying to focus on what's happening in the market. And one of the things I'm seeing is that what I'm seeing now is that a lot of regulations are coming in, and regulator is really active in trying to enforce the regulation. Not only bringing the regulation, but trying to enforce the regulation. On the flip side of that is the cost of compliance will go up considerably as the companies will try to comply with this regulation. But I think some areas where, for example, solvency, receivables, and these areas will help insurance companies to perform better in the market. Also, it will help in terms of their risk selection, their underwriting discipline, their systems, and things like that. So I think that's a positive that's happening. Flip side of, again, as I said, the cost of compliance and all that. Then, for example, lines of business like motor have seen hardening of the rates, and the rates are increasing, which is helping the profitability of those lines of business. But the inflation in healthcare and all that is considerably increasing the cost of medical insurance. So that's something which industry has to look at it and properly manage. So I think overall, if we look at it, the compliance is playing a role, helping industry to discipline itself and perform better. And better rates in the lines of business that were making losses is also helping them. That's not good. Okay. So, yeah, wow. I have to say it all again. Okay, I'll try to summarize what I said. So what I said was that the compliance from the regulations that are coming from central bank and the implementation of that regulation, and where central bank is becoming more tough in implementing those regulations, is helping the industry to have the self-discipline and improve the underwriting profitability. Similarly, the increase in the rates in motor business is also helping industry to come to a profitability in that line of business, which has been historically making losses. Flip side of that is the cost of compliance is increasing, which is also a burden on the insurance company. And the time to do the compliance also creates problem. Other side is the medical costs, and the inflation in the medical cost has always been a problem. And I think insurance industry with the providers have to work with them to resolve this issue of controlling the cost of medical claims. And I think that is an area where probably a lot of time has to be devoted by the insurance companies in controlling this. Other factor is that we are seeing that a lot of companies which were not solvent for a number of years are effectively working and coming back to solvency, and the boards are taking the solvency matter more seriously. So we see a lot of capital injection that is happening in the industry, and those companies are coming back. So that's a good sign for the industry that this part of regulation being implemented, and effectively boards are taking care of that. Shareholders are on board to make these companies solvent, which helps insurance policy holders to work with the solvent companies. So I think this is my take on industry, given that I was out of the industry for a number of years. Thank you.
Good afternoon, everyone. To the BADRI team, thank you for having me again this year. So I echo everything that Jason and Parvaiz said fully, and I'll just add a couple of small points to them. One, which is related to the MGA point, I think it also can be extended to the reinsurance brokers. I wouldn't call it explosion, but the mushroom growing, industry or side of the industry. And it's, with all due respect, it's not about the quantity or the number of new MGAs or reinsurance brokers that are coming into the industry. The challenge that I feel that we are going to face down the line is that these are not, and the DFC colleagues might not be very happy with me, or especially on the DFSA side. I don't think that they are being very much regulated as they should. Opening an operation in DFC now is more, and I know that I would be crucified for this, but it's more of a hospitality business. I have offices, I need to have these offices, occupied. That should not be the way. Because it would be very embarrassing when one day the CBUE sends to the insurance companies telling them you're not allowed to deal with X or Y, being a reinsurance broker or MGA, that is actually regulated by the DFSA. It would look very bad. I was having a discussion with a colleague, a senior colleague from DFC side, and I proposed to even go and have a discussion with DFSA on this, because I think much more scrutiny should be there, be it on the MGA side or the reinsurance broker side. We're not speaking about retail operation where you can, excuse my language, screw up in one deal. We're speaking about multi-million dollars worth of deals that can bring a company down. So it's not a joke. So I think the negative impact didn't come yet, but the risk is there, and because of that, I see this as a negative development that happened in 25. On the positive side, again, I echo everything that Jason and Parvaiz said. I would add to it that we did not slip as a market yet into a price war versus other markets neighboring to us. Post the positive results. Unfortunately, what we've seen in the neighboring markets, especially in Saudi Arabia, that it's very cyclical in the sense of they go from positivity to negativity from one year to the other, as simple as that. Actually, sometimes within the year, 2 quarters positive, let's bring the prices down, especially on motor. We haven't seen this here in UAE, which is a very positive sign. So increasing the prices or correcting the terms, for me, it was a normal outcome post the large losses that happened. But having the resilience to maintain it to a great extent, for me, this is the key highlight for the market. Thank you very much.
Assalamu alaikum and good afternoon, everyone. Thanks, BADRI team, for inviting me again over here. First of all, I think the disadvantage of being towards the end of the table is that all the points are already covered. But I think just to echo what the rest of the panelists have mentioned, what really is encouraging in this market is to see the unified framework of regulatory framework that has happened with CBUAE taking charge of the insurance market as well. We see how the banks have consolidated and performed well. We just saw the numbers by the previous presenter, and we see the banks performing quite well because you have the right size within those banks. And I think with this new framework, we will see similar direction of the insurance market as well. And I think that is a good development for the market. We've been talking about this in action from a regulatory perspective in the last so many years. So this change will bring a lot of positivity and the enhanced enforcement around that. We've seen revocation of a license. We have seen an insurance company which had to withdraw one of the product lines. We know few companies are on the watch list. So there is quite a clear activity and shift from that perspective. I think that's the real advantage when you have a unified regulatory approach. On the negative, I think not even negative, I would say something which I would like to see in the market happening, I would have loved to see last year was more M&A activity. We have quite a few players in the market, and we want to get to a size at the insurance company level where you are able to utilize the efficiencies and the scale. That is something which I think our neighboring country at the moment in KSA, you have seen that activity, you have seen quite a bit of success on that side. I think in the UAE, that is one aspect which should start getting in more higher activity level and successful deals being completed. I think that's something which we want to see.
Thank you. Thank you, Hatim, for having us. And like you said, towards the end of the panel, you have all the points covered. The other is that you don't, your mind stops to figure. No, I like it this way. At least I get more time to listen to all of you. And I think I'll just pick up specific to Oman because I'm based in Oman. So I know when Dubai sneeze, we catch a cold. So we caught a cold last year, which was negative for us in the market because while Dubai didn't face the price increases on the RI side, all the RI started to say Oman is a catastrophic zone. So no discounts on your RI renewals. And look what happened in Dubai. And I'm talking to my friends in Dubai. They said, oh, we have the same renewals. We even have maybe better terms. So, that's negative for us because we're a small market. And also, I think on the MGA, what you've said earlier, obviously there is an interest that increasing MGA capacity is coming to the market. But for us sitting in Oman, what is worrisome is that there is an offer of A+ securities at very low terms, which we also have our doubts that whether they'll be able to fulfill their obligations come a time because of insurance. Typically, we have seen so far we've been able to meet all our obligations. But like Ahmed said, we are like the thieves, or perception is that we are not honorable people and we will run away. So should actually there come a claim where we are not able to honor it because of a lack of due diligence that has happened on a client's end or even our end where we've just forced to go because we don't want to lose the market share, is going to be a big negative, and we got to keep our eyes and ears open for that. So we have to make a compromise between market share or quality, because so far we know that if you want to stay in the business long enough, quality is very important. Positive side on Oman, we've seen that the regulator has introduced a unified credit life, individual credit life policy, which you also saw in the slides. So we are seeing a good, increase in the coming years. So that's also giving insurance companies like ours or those who are in life, a good runway to see how we can plan for our future growth. And we hope that, that stays that way.
I just realized that I'm the only one representing the reinsurance industry on the panel. So I think there's one comment I should definitely make. And I've got Ahab sitting over here who's heading our medical business. And what I see is this MGA problem is a real problem because we see some completely non-technical price competition that comes on schemes. And as a reinsurer who has been here for the last 20 years and will be here for the next 20 years, we definitely don't compete with such courts. But there are players who do utilize these courts. So what is the credibility of this court? We'll eventually find out. But this definitely is a problem which is quite evident in the market.
So moving on, Ahmed, you mentioned about the price war. Like prices have improved. The good part is in UAE they've improved and it stayed up. Saudi, you're right. It was 23 was very good, and all of a sudden we saw rates coming down. How can we ensure we do not slip into a price war again?
I wish that there was a clear-cut answer that would say there is something that we can do to prevent a price war going forward, but we cannot. Okay. And I don't think that we should stop a price war. I think, we should think, why would we want to stop a price war? It's more of the sustainability of the market itself, so that the insurance companies remain to be there and remain to be there in a profitable manner, which in reality is the, I would say, job of the regulator. Now we need to remind ourselves that UAE is a young country, but what we even need to remind ourselves of more is that the central bank has taken control of the insurance industry less than 4 years ago. So it's very new to the industry. And while we believe, I personally believe, that we are very much underdeveloped in terms of regulation, in terms of the market practice, but when you just compare it to the 4 years, 10 years that has been there, actually we've done quite a lot, taking this into consideration. So this goes to our regulator, where we've seen in neighboring countries, for example, they do not control the pricing, but they control the results. So in neighboring countries, there's a rule, for example, that if you, for more than 2 years, deliver negative underwriting results, you get stopped from writing that line of business. Unless it was part of your business plan that was already provided, you're establishing a new company, you would be losing for 3-5 years till you break even. But if you are deviating from your business plan that has already been accepted and presented to the central bank, because you are delivering higher gross loss ratios or your pricing is below the actuarial price that should be there, they actually come and stop you. So I think this should be the trigger, because assume that I am magical in the way that I am managing my claims. I am able to get a severity that is 50% of my peer, and I'm able to give a price that's 50% less than my peer. If I am, genius enough to still make money, that's a problem of the market, not my problem, right? So we should focus on the profitability. The regulator should focus on the profitability and should stop insurance companies that slip into continuously writing business at a loss that would hammer the market later on. And we have seen it, of course, in our market, unfortunately. I think this would be the angle where we can tackle this challenge from.
That's a good point. Jason, anything from your side on this?
Well, thank you very much. I mean, I couldn't have put it better myself. I absolutely agree with what you said there. And I think it is the profitability angle that is a legitimate area for regulators to operate in, and we certainly do see it in other parts of the region. I think beyond that, though, I think we have to be realistic as insurers. People talk about cycles all the time, and I've been in the business now for more than 40 years, so I've seen a few cycles in my time, but I think the cycle thing now is total baloney. Most of the time, markets are soft, and you have to adjust your business model to that reality. And the softness of the market comes from many different reasons, and the cocktail of reasons changes at different times in the cycle. But the general effect is that prices are always under attack, except for very short periods when they're not. So I think you have to be very realistic about that. And I think there's often, not that you were doing it, but there's often a lot of commentary which is a bit, frankly, pie in the sky, quite honestly. There's an avalanche of capital globally available for reinsurance business and thus supporting insurance business all around the world. I mean, it's certainly not something that's unique to the Middle East. I mean, everywhere you go, you will see that. And what insurers have to do is to adjust their business model to that reality, because otherwise you're just, standing outside shouting at the weather. So I think you have to do that. But I agree totally that there is a legitimate role for regulators in insisting on reasonable profitability. And I would urge the central bank to look at that. I guess perhaps you and I are seeing them tomorrow. We may have an opportunity. Yeah, maybe have an opportunity to bring that to their attention. And I certainly think that would be a good thing. I mean, the UAE has not had a kind of interventionist philosophy in lots of areas of commerce. I mean, and I think that would probably be almost like a kind of philosophical difference between the UAE and the Saudi. So I suspect that they are not just going to sort of photocopy a Saudi approach. But even if they were to say something about the profitability of particular lines of business, I think that would be an encouraging step.
Neil, anything from your side from across the border?
While I agree on the approach that regulator should intervene and send a technical, I would say more like a modality on how companies should look at their, or how board of directors should actually look at their company results. Because I think what is missing is the fact that the regulator is thinking it's not their problem, it's the problem of the board or the shareholders, those who invested in that company. And we as executive management are thinking it's the regulator who should step in, because boards and shareholders are not seeing it technically the way they should be. It could be lack of insurance experts on the board. It could just be that it's a very small capital allocated to this business, so it doesn't make much sense. They've got bigger fish to fry. But collectively, that problem has to be addressed. Maybe if it's not being addressed at the board level by the regulator, at least initiating to set the rules that this is how, if anything below this is a red line, and will not look at overall solvency as a measure, but an individual underwriting profitability for each line of business.
If I may add, I think we have to look at it from the point of view of how the insurance companies operate in this market. And many insurance companies on certain lines of business are just pure brokers, if I can't use the proper word. I wanted to be a bit kind. I wanted to be a bit kind to the insurance companies, but anyway. And they take risk and place it outside. So obviously, when there is a soft capacity available in a global market, the market in the local market becomes softer because of that cycle. Then there are lines of business where insurance companies are retaining risks on their book, particularly, for example, motor, where most of the treaties are on excess of loss, and the own damage claims or property claims are paid from the premiums they have kept in their books. Now, at this point, we can emphasize that market can operate on a purely demand and supply principle, but demand and supply principle can lead to equilibrium of a price at a point where it would be not a viable price. And when this happens, there is a need to introduce some kind of a floor through a regulatory intervention. If that regulatory intervention doesn't happen, then that floor will not come in. And for example, I was looking at a presentation made by a colleague here on a motor, and he was showing all the burning cost and everything. That data should be available from a regulator in a public domain. They should be able to give you the frequency, the burning cost of claim, and based on this, insurance companies should be guided, or actuaries should be guided through the regulator that, look, when you're doing a pricing model for insurance company, keep these things in mind. Without the availability of data and pricing on my own data as an insurance company, unless I'm so large that I have these data points which would accurately reflect the market experience, then it's a different story. But if regulator provides the market experience through actuarial, all the data points, all across, all Emirates, all kinds of cars, age brackets and things like that, the aggregated data of the market, it will help insurance companies to work proper pricing models based on that aggregated data. Also, each insurance company will have refinement in that process. For example, somebody can do a better claim management. They can create that margin in their pricing model and say, look, I'm doing better claim management, as a result of which I'll be able to compete in the market. And that's where the real competition starts. If you have a data points that are available, and that data point information is available across the market on an aggregated basis, so there is no distinction between the companies in having the data. That's data is aggregated without names and everything. That's one thing. For example, in medical, again, it's largely driven by pricing models that reinsurance bring on the table. Again, reinsurer may have their own views on the groups and sizes of the groups and things like that. And again, the data will play a critical role. The data should be, all the TPS collect so much data, but there is no aggregate source of that data being available. So I today, if I want to see a frequency of inpatient claim, I cannot see. Particular TPA can see and give it to me. If I want to see a severity of outpatient incident each time, or I want to see a frequency of outpatient incident depending on the number of lives insured, I cannot see those. And if those data points are not available, that's a challenge. And I think that's where the regulator has to walk in and say, look, I am going to be a provider of a data on which you can base your pricing. Rather than working on the profitability models, all these are relevant, but I think availability of data is more relevant in the market when you want to do a correct pricing. I think that's my take on it.
So, since Owais is here from the reinsurance perspective, staying on the same topic of data sharing, and there are two elements. One is the underwriting data in the sense of having, let's say, burning cost information. And right now, technically in UAE, we have a claims report that is supposed to go out. So that is one side of things. Second side, I've also seen in some markets where they share credit data in the sense that these are companies who have defaulted, because there's a habit where people buy the insurance, or large corporates, they buy insurance and then they try to keep some premium payments pending until the end and either use it as a negotiation or they default on it. So what has your experience been in this area, and should this be happening?
I think first of all, what Parvaiz Saab mentioned, I think I completely agree with that on the actual claims data. But coming to the point that you have mentioned, first of all, we have to see why is it not happening in the market? What are the triggers for this not being present? And I think if you look around, it comes back to the same point that we have just got too much capacity and too many players in the market. So there's a lot of competitive pressures for people so that they don't really share the data. And I think this unless you sort that out, you will always have the issue. People will not be able to share the data with complete clarity. Secondly, you also have sometimes the liability issues, because if the data that is shared and is used, and if there are any issues on the data front, who takes the responsibility for that? So I think that is that aspect which you need to also take care of. And then I think going back to what Parvaiz mentioned, there is no standardized format at the moment. There is no structure that can be used by the industry players. What can be done? Definitely the regulator can take a step forward. They can be regulatory push. They can be, we have got models around from our within the region and international models which can be adopted around that front. Secondly, you can definitely create industry pools, and industry pools both on the claims data front and also credit data front that are very useful. You see them in Europe quite regularly, and they're quite helpful in not only the underwriting part but also on the pricing front. Lastly, I think one thing which I feel we've not touched up till now is the technology front, and the way technology is evolving and the solutions are coming into the market. There's definitely a case, business case for having, I think, a solution around a blockchain-driven ledger, which basically you have immutable data, which is shared through permissioned access, and that can be used across the industry. That and it's a market in especially in UAE where technology is adopted quite widely, this can be adopted and used. The advantages of data we are all aware of, I think, both from an underwriting and pricing perspective, and I think that we don't have to say much about, but fixing these issues which are curtailing this is the most important thing.
Okay.
Let me put it this way. When we look, and I'll just use health as an example. When you look at the health line of business and you look at the value chain, the ones who own the data from a legal perspective don't have it. So you look at the value chain, you look at the provider, they have all the data. You look at the TPA, they have all the data. You look at the reinsurer, they have most of the data. You look at the insurer, they have none of the data, right? Including the client. The client receives the famous DHA report, right? that is manipulated, does not reflect the reality, and doesn't have any details. It doesn't tell any story. So I think this needs to be corrected, and this needs to be corrected from a regulatory perspective, as simple as that. I would like to start lobbying with the regulators on this. The regulator should force the TPAs, because I've had discussions with TPAs where they are reluctant to share the data with me as the owner of the data, because, and I understand their point, they would like to protect the service cost because that's the secret weapon. So let's call things what they are, right? X is contracting with the Saudi German for consultation at 300, and it doesn't want to reveal this price because that's the secret weapon for bringing down the claim cost, okay? Which I fully respect and understand. But at the end of the day, the insurer and the insured, they own this data. They have to be able to look at it, to be able to price, understand where is the leakage happening, how can we control it, how can we improve, and so on and so forth. So I think there needs to be a regulatory intervention where the TPAs are instructed to share uniformed reports with the insurers on the performance of the specific accounts. It's as simple as that, and it's not something that we're inventing. It's there everywhere else. It's here. It's just I think maybe because also the market is a bit immature, so it started by TPAs doing the insurance and the TPA role. Then insurance companies started coming into the picture. So it might take some time to evolve, but we need to accelerate this. So that's the first point. Second, as Owais was saying, there needs to be a centralization of the data, and as Parvaiz said as well, at the regulator side. When you look at the motor claims in Saudi, it's already there. The centralization of the claims data. You know if this client had a loss or not. Now, with the technology adoption, the aggregators coming into the UAE, which is a brilliant move, but all of the policies that come through the aggregator, for example, for motor insurance, all of them have declared that they have no losses. It's a joke. You know that this is not true, but you cannot, counter this because you don't have access to the real data. So I think coming from the regulator, and I don't want to be, putting a lot of burden on the regulator, but I think this is something that needs regulatory intervention.
Yeah.
Quick. And it is just an experience from US. Every medical claim that gets processed in US, the insurance company is required to issue explanation of benefit statement. An explanation of benefit statement comes to the person, to myself, for example, if I'm insured. It will say, my provider billed me $500 for the treatment. My insurance company approved, based on their standard table, $300. $50 was my copay, $450, and claim is settled. So I know exactly how much the provider billed, what exactly the insurance company approved, and what was my deductible, and then they close the claim. If there is a co-insurance which I am liable to pay, they will indicate on that explanation of statement that I need to pay this co-insurance, which is in above the deductible. UAE, you will not get single data like this. And that's a big difference.
Yeah, I think that's like you said, even the insurance companies owning the data are not getting the data. And just switching gears a bit, especially from the Omani side, one of the things that I've started hearing a lot in Oman is that there has been an advent of ambulance chasing lawyers. We hear a lot about this in more, let's say, Western countries and all, that ambulance chasing has started. And the other thing which we've started seeing for a few years is the court awards for bodily injuries. They have been very erratic. And they've also been erratic in the sense that the lawyers know which courts we can go to get a good judgment. So what I just wanted to get some background from you and some experience from you on this side.
Yeah, this is, I think, a very unfortunate part that we've started to see recently. And that is also because of influx of a lot of qualified lawyers, because that part of education has really done well. And Unfortunately, they've picked up this worst thing from the West, and without corresponding appreciation that the premiums will also end up going higher if this is what is going to happen. And from a customer's perspective, if I take one step away from, let's say, the insurer, the customer anyways doesn't trust his insurance company. So he's like, okay, this guy has come in and he's telling me that whatever my insurance company offers, do not accept it because I'm going to get something more. He's bound to trust that guy. So what it has ended up in more court cases and higher cost of litigation, which is reflecting in the increased burning cost, and it is also reflecting in that the average motor premiums are started to go up. It's going up slowly, slower than it should, but it has already started to going up. And regulator has stepped in and wants to have a dialogue to figure out why it's going up. So good thing that has happened from it, that it has now come to the forefront that BI, bodily injury costs, are going up. Ambulance chasing lawyers are one part of it. Erratic court judgments or uniformity in applying the motor unified law is the other issue, and transparency is the third. So what we have proposed, and we're going to keep doing it at our end along with the industry colleagues, is to bring all the four bodies, the lawyers, the judges, the insurance companies, and even the consumer forums together to explain that there is a merit, including the regulator, in terms of unifying the bodily injury scale, having a common understanding so that it is easy to interpret, and not fall into this trap of taking every case to court, because it increases economic cost as well. It's not just insurance cost for me, it is also the cost that the government has to pay for the courts, and the actual cases which should be litigated are actually getting drawn into the background because there's no time to do the real judicial work. So a dialogue is extremely, extremely important for it to have, but this has brought it up to the forefront because it's right now on the social media. Everybody's looking at it and everybody's saying like, this is not the right way to do this thing. There is a better way which will ease the pain for everybody, because as an insured, I've suffered a loss. Anyways, I'm in pain. Now on top of that, I have to deal with the uncertainty if my claim is going to be handled correctly. Should I go to the lawyer, wait for 6 months, 9 months, keep encouraging, it's an expense. It's also frustration. So it's not good for anyone, but hoping that this will actually bring sanity into the process and we'll be able to do it in a much more civilized way.
And Jason, what has your experience been? Because you've seen different markets where this is a common practice.
I wouldn't say that our experience has been quite as dramatic as what you're saying in Oman, but certainly we've noticed an increased number of attorneys and this phenomenon. I mean, it is certainly playing there. And I think for all the reasons that you said, we have to be very vigilant about that. I mean, certainly we as a company do everything we can to keep things out of court. Because, even before you get to the problem of ambulance chasers, we know what a lottery going into court can be, and what an emotion-packed rather than legal argument that usually is. And certainly there is a lot of variation in judgments and in the quality of judgments. And of course, inherent in the system that we have, a sort of quasi-Sharia system, is that that really the idea is that something bad has happened and who's going to pay for it. And usually that's the big guy, which is usually us. And so that's really the starting point for all these things. I think the other thing I would say about this is that I think we do have to recognize that, and of course it's all relative to premium, but I mean, the judgments that historically people had in this country were not very high. And if you look in other parts of the world, they were quite low, and that was perhaps appropriate at a time when the country itself was not all that wealthy. But now we're a country of a lot of well-paid and well-heeled people, and if they are badly injured in an accident or even killed, there is going to be some significant loss to them as a family, which perhaps 20 years ago was not quite so stark. And I think we have to recognize the changes that we see in society. And as insurers, we have to react to that, of course, in the context of the premiums we charge, of course, but I think we have to recognize that. So I don't see it at the moment as, you know, something that is quite as dramatic as you are saying, but it's certainly something to be on top of. One other point I just wanted to make there about claims costs, and I wonder if some of my colleagues here have also noticed this. But quite rightly, the government introduced an ombudsman system into the UAE a couple of years ago, I suppose now. Sanadec, it's called. And I don't have any problem at all with the concept of an ombudsman. I think that's something that you see in many parts of the world, and it's a perfectly rational thing for a sophisticated country like this to do. What has interested me is the way they charge, which is that if the complaint is justified or unjustified, the charge is exactly the same. Now, I suppose I will wear my rather smug face now and say I don't actually face an awful lot of complaints, but even so, for us, it is an expense as a business which we certainly didn't see a year or two ago. And I do know that some of my neighbours in Abu Dhabi have faced charges of millions for the complaints that they have, and we'll have to think of a way of passing that on to the customer, I think, because it's a not insignificant amount.
Okay, yeah, that's interesting. So there's a lot of talk about solvency as well, and I think Munich and you guys have been active on the solvency side as well. So just wanted to understand from you what sort of trends are you seeing in the market, and what sort of things have you done in the market on the solvency front?
Sure. I think what we see is, first of all, what we see in the market is quite good, that we're moving more towards a principle-based regulation approach, risk-based solvency approach, which is a tendency that you're moving towards a more mature market. And if you see the new regulations, the new law, it's quite clear that proportionality is now at the heart of it. How they implement now, that is something we will have to see. But at least on the clear definition for the actuaries and the auditors, you have a clear direction on how to move forward on the solvency side, which was important. What we can definitely learn from is also, it's modeled similar to Solvency II, and now Solvency II is going through an upgrade now in Europe, and which will be implemented from Jan 2027. They have had a 10-year run with the Solvency II, and there's a lot of things which they've brought in from those learnings into the new Solvency II regime. And there are two things which stand out from that, which actually we can benefit from in this market. And one of them, first of all, obviously they do improvements on the capital requirement and the calculation front, which is, I think, quite technical. I don't need to bore the people over here with that, but more on the conceptual side, there are two concepts which have been added now. One of them is having a liquidity risk management plan. And I think that's something good, especially for, we've seen companies over here struggle, especially the medium to small size companies. For them to have a very clear liquidity management, liquidity risk management plan, that is something unique and that can be brought into the picture. Secondly, I think there's a recovery and resolution plan as well, which is basically depending on which solvency level you are in, you need to either come up with a recovery plan or a resolution plan. And this, I think, from a market which has got more than 60 insurers operating at different levels, that's a learning which we can bring in. From a Munich Re perspective, obviously we have our traditional reinsurance solution, which do help in the risk transfer and helping the balance sheet from a solvency perspective. But I think we are the only reinsurer on ground over here which does financially motivated reinsurance as well, solutions, which are more targeted towards the balance sheet. And you have basically, the idea is to have a capital and solvency management, having solutions both on the asset and the liability side of the balance sheet, stability of earnings, I think earning, and that's something which we bring into our structured solutions, You have financing through your embedded value financing or cash flow financing, which can be brought in to enhance your capital and solvency position of the company. And I think we've been doing that over the last more than 6 or 7 years in the region and successfully executed these transactions. So, and this is a sign of a mature market to have the financially motivated reinsurance, because that shows the companies are getting to the size where they realize the importance of these solutions, because these solutions are quite widely used in US, Europe, and Asian markets. So that's where we see this market as well. We see our financially motivated reinsurance developing quite smartly.
And you're getting the acceptance from regulators as well.
I think initially, obviously, when you talk to the regulator, they're a bit apprehensive. But when you show them how the solution is working, how it's strengthening the balance sheet of the company, and when we are able to present to them how it is implemented in the more mature and developed markets, they normally get on board. And I think in this case, every case is a unique. There's no standard template that you can apply across all companies. Every company has a unique case. Every balance sheet is different. So I think our solutions are very tailored to individual companies. Yeah.
And Ahmed and Parvaiz, from your perspective, like both you, like I would like to get some background from your side as well, in terms of how you're seeing the changes happening now.
In terms of
the solvency and the push, and the changes in the attitude from the regulator as well, if you've seen any.
I think what we have seen from the regulator is that the enforcement is improving. So constantly in all the areas, the enforcement is improving, and solvency has become a big area of enforcement in terms of. And I think one other thing that has come to realization is that the shareholders and the boards are also taking a lot of interest now in solvency issues. So I think this is a shift which has happened, because before, if you go and present to the board and you try to explain to them that we need to comply, they will say, okay, we will use our connection, talk to this, talk to that, and resolve the issue somehow. But now, I think that thought process is gone, and they are saying, okay, tell us the issue, what we need to do, let's resolve it. And that's where I think I'm seeing bigger of change. Other than that, other regulations, for example, premium collection and all that, are playing the role. And if premiums are collected properly and timely, the burden on the company goes less. Investment strategies are other area where we're seeing a lot of focus now from the insurance companies to improve their investment returns and come out of legacy real estate portfolios and stuff like that. Because I think one of the things that has helped is the growth in the real estate market, and the prices have improved. So exiting the legacy portfolio has become easier. Before, it was quite difficult to exit from that legacy portfolio because you need to book the losses. But since the market has improved, you can come out of that legacy portfolio with the gains rather than losses. So I think these are a few areas that I've seen.
If I may, I'll just target it from a bit of a looking ahead perspective. So everything that has happened in the market, from the regulatory enforcements, companies realizing the position and the challenge that they have and trying to correct it, is of course there. But I think what we may need to look at is the fact that this is a very fragmented market. You have 60 plus companies, right? And it's not only fragmented, it's fragmented and very, I would say, bipolar, in the sense of you have the strong players, and then everyone else. And I think that the smaller and medium-sized companies are realizing more and more that if you're not one of the big boys, you will not be able to make it. And for you to be one of the big boys, you need to be rated. And for you to be rated, one of the aspects is the solvency. And I don't believe that it would be easy for any existing shareholder for a small, medium-sized company to come and say, you know what, I'm doubling the capital for this company with the hope that in 3 years you would be able to be in the A-rated club, right? Which would bring the need for the balance sheet and earning solutions to help in boosting this till the confidence from the shareholder is gained, particularly if you consider the low return on equity that is there currently for our industry. Once you hit this point, then shareholders might be encouraged to, okay, let's replace or complement the balance sheet models, reinsurance models that we're buying by actually putting in capital into the company. I personally am expecting that there would be a hike in bringing those solutions into the market, especially for the medium-sized companies.
Okay, yeah, that's a good point. Just switching gears a bit, I think a couple of years back, Jason made a comment in our conference that IFRS 17 has been the biggest scam in the insurance industry. So now, 2 years down the line, I wanted to understand from you, like, what sort of changes have you seen in the reporting, internally, the way things happen, how you present to the board, how it's reported in the market? Because for us, making an industry report has become more difficult than easy. Right? Earlier on, we used to have very good KPIs. Now our report has become less useful because of some of the disclosures. So I thought I'll get some insights from you on this.
Well, I don't think it's any great secret that I'm not the biggest fan of IFRS 17 that you've ever met. Since I made that rather low-key comment at your conference a couple of years ago, I'm always meeting people I'd never met before who said, Hatim Maskawala told me about what you said about IFRS 17. Look, I mean, first of all, one has to be realistic. Whatever we think about IFRS 17 in the UAE or in this conference, it is the standard, and it's not going to go back to IFRS 4. But I do think that there are some lessons that have to be learnt by our friends in the accounting profession about this thing that's really been foisted on companies where, frankly, there wasn't very much wrong with IFRS 4. And, I appreciate that there may be, life insurance or other types of companies around the world where these comments wouldn't apply, but they certainly do apply in a place like this in the Middle East. And we've all had to spend an enormous amount of money changing a standard that wasn't really all that bad into one in which even now, and even the genesis of this question really is, how many people here are actually using IFRS 17 to manage their businesses? Or is it, as I suspect, that everybody's managing their businesses in IFRS 4, and then 3 days before you publish your results, you're putting into the Google Translate, and out comes the IFRS 17 number, and you're either very surprised or quietly happy. I'm looking now at the back of the hall at my accounts manager, who's intimately involved in all this. And this quarter, we only had a 500,000 dirham difference between our two accounting standards. But are any of you actually running your budgets in IFRS 17? Are you really doing your planning? Now, if you are, I'm all ears. But I think most people, and by the look of on your faces as I look out on you from the podium, most people are in agreement with this. And whilst that is funny, it's also a terrible indictment of, I'm sorry to say, but the accounting profession who made this change, because there are very good reasons why we're still using this stuff. Now, okay, well, we have to say uniquely perhaps in the UAE, the regulator's still using IFRS 4, so even if we had converted, we would, we'd all have to still be reporting in IFRS 4 anyway. So, but that's a kind of parochial problem here. But I don't know what the answer to this is, quite frankly, but I think that the accounting profession have to look and understand why is it that their real customers are still using combined ratios and loss ratios and all the other very familiar metrics, while many companies still talking about gross written premium because that's what everybody understands. Why is it? And isn't that a terrible indictment of the way they did this? So that's my 2 pennies worth.
Looking at the reports, one of the big objective of IFRS 17 was that we will be able to compare insurance companies and their data points, and they will look all the same, and it would be easy to understand, and all that was the objective. Today, you open a report and you try to compare these two companies, and you start to read the notes. Oh, they followed that model, and their rate of adjustment or discount was this versus that. And to me, comparing gross premium was much more easier than comparing what is called service
Insurance revenue.
inter-service revenue. So today, if I look at a report and I say, okay, explain to me how this number has arrived, I have to go through set of so many calculations to come and understand that number and then to compare that with other insurance company. So you go through the same set of effort to see the number of other insurance company and they say, yeah, they use their discount rate was slightly different from this one, and as a result of which their revenue would look different from this one. So I think idea was good, the outcome is bad. So that's what I would say probably.
And Neil, from your perspective, because I think you are in the middle of the implementation now.
So we started this year, so we had the experience to look at all industry colleagues and see how they have done. Because the Islamic insurers, the FAS 42 and 43 standards came much later for implementation. So thankfully, by that time, our board had become ready that it is going to be a black hole and we'll never be able to tell them the result 15 minutes before the closing bell at the stock exchange. So yeah, you're right, Jason. We still do it, budgeting on IFRS 4. We still do our thinking on IFRS 4, our monthly meetings on IFRS 4, and the IFRS 17. So far, we've been quietly happy at IFRS 17 versus IFRS 4 because our business is long term and there are certain benefits. So we're trying to take the best from there, but we still are not we're not there. I'm hoping. I was hoping in this session to get some insights on how others are doing it. Maybe we are missing missing some points here on how we can interpret it better. I thought maybe some of the people who've implemented it earlier would have now figured out how to manage their business of IFRS 17. But even the regulator, the solvency calculations is IFRS 4. Everything is IFRS 4. It's only the reporting is IFRS 17. So this year we're actually trying to do our budgeting on IFRS 17. But whether we'll be able to do the quarterly reviews on that remains to be seen. So yeah, but the jury's out there.
I think one of the things I've seen a lot of companies do, and maybe it benefits everyone, is close early. Because that, like you said, the stock exchange bell, especially in Oman, it's very close. It's 15th of January or 15th of April. So a lot of companies have actually started closing their financial statements maybe 15 days back or at least 5 days back, so that calculation can be done faster.
Yeah, but see, Hatim, what you're proposing is trying to solve a problem, try to avoid the pain of a problem. But the reality is that the problem is there. I was fortunate enough to have worked with international companies all my life. And I can tell you without a shred of doubt, I've reached out to all of them. So to my ex-AXA colleagues, Chubb, that was previously ACE, RSA, and all of them globally, I'm not speaking, in the region, are still working on IFRS 4 and doing in their presentation the bridge. These are our performance, and this is the bridge, transitioning from IFRS 4 to IFRS 17. It's so I actually echo what Jason has said 2 years ago. It's a complete fiasco. Exactly.
This is the profit from IFRS 4, and this is what trickled down to IFRS 17.
Agreed. I think I've taken a lot of time in the questions. I just wanted to open it to the audience as well. If there are any questions, if you can just also mention whom you would want to answer the question from.
Regarding MGA, the first topic, I find that a $30,000 is the capital required, right? That amounts to less than the salary of a person working in that company, right? The insurance companies, when they have to transfer the insurance premium to this MGA, who in turn will have to transfer to the reinsurers, there is a risk involved. If for some financial reasons or any kind of difficulties they face, the MGA faces, if the money is not properly transferred in time to the reinsurers, who bears that risk? Likewise, in terms of a claim, when the claim amount is transferred to the MGA, and then if that transfer to the insurance company, the cedent, is delayed, Who takes that risk? This is a big problem because it now has been revealed that it's only $30,000. That's a small amount that doesn't even cover the salary expenses of an employee of that company. It's a big risk.
You're absolutely right. That is a concern. Now, of course, an MGA is the managing general agent. So in law, if you've paid the agent, you as the seeding company, if you've paid the agent, then you would think that that would be okay in the scenario that you're outlining. But would it? You know, if you've got a company that is not operating properly, and we know in our business that, you know, things unwind over a long period often, then you've got a dispute. As I say, if you've got a good reinsurance company at the back of it, maybe from a reputational point of view, they will stand by it. But you're going to be, you know, it can be a slow pay, even if it's not a no pay. And I think that, as I was saying earlier, the chain of security there, the chain of confidence, if you like, needs to be, the spotlight needs to be shone on that more, because there certainly are MGAs where that wouldn't be a concern. But there's not really any proper rating of MGAs. I think AM Best have been doing something, but it's not a very developed system. And I think that would actually help the MGA community a lot, because I mean, doubtless there are MGAs, some of them very well established, that, you know, one wouldn't have the same concerns about. So I would encourage that community to get on board with that. Would certainly give me as a buyer a lot of comfort. But I mean, really, in the end, an MGA is a distribution vehicle. I mean, it has some underwriting expertise in it, but I mean, it's a vehicle that's bringing business to a reinsurer. But you know, you're paying. I mean, the other point. I mean, you know, I'm an old Lloyd's boy myself, and I certainly would acknowledge that Lloyd's has many weaknesses. But I think that one lesson that the DIFC could usefully learn there is that that in the guardianship of their own brand, they have to become more involved in the quality of the offerings under their umbrella, because undoubtedly, if there's a failure of the sort that you're describing, even if that happens once, that's going to have a lot of repercussions for the rest of the entities in the DIFC. And, you know, Dubai, I think, quite rightly, is very jealous of its reputation and very, you know, guarding of its reputation. And I think this is a real area of risk if they're not careful.
Just to clarify, sorry, Owais, just to clarify one point. So I don't think that any of us have anything against MGAs. I think I personally am dealing with MGAs. But the risk is that the majority of MGAs now are in reality a one-man show. So Ahmed shows up, he's trusted by these couple of reinsurers because he has the background, has been in the market, he gets the capacity. Ahmed gets an offer tomorrow from Munich Re, he leaves. What happens to that MGA and to the contracts that are there and to the sustainability of the business that is there? So I think we as insurers would be much more comfortable if the MGAs turn into institutions, that I know that they would be there tomorrow. You know, if you're going to go and buy a sandwich, I think you would feel more secure to buy it from a restaurant as opposed to buy it from a cart. You know, you don't know if the cart will be there tomorrow or not, right? So it's more from that perspective.
What I think is that actually the cedents should be insisting for citing the agreement between the MGA and the reinsurer to see who bears the risk of remittance. That should be very clearly defined in the agreement between the MGA and the reinsurers, so that if the reinsurers take that risk and the cedent transfers the money to the MGA, if he fails to make the payment or transfer the money to the reinsurers, that risk, if it is borne by the reinsurers, of course, there is no problem, which means in all cases, the cedents will have to insist for citing of that document, which we are doing in many cases, but this is very essential. for onboarding, there has to be a checklist for onboarding the MGAs to find out whether all these kinds of issues and the risk areas are properly addressed. Otherwise, there will be problems, especially as he said, one-man show means if that be the case, it's not, there is no guarantee that it will be a continuing organization, continuity of the organization. If one person has any kind of problem, where to go for the money, for us to get the claim, or for transferring the money to the reinsurers. These kinds of aspects, I think, shall be very clearly defined in the agreements to be cited by the cedants so that they will feel more comfortable. I think so.
I think I don't want to get into the discussion about this. I think MGA has been, we've discussed it in detail. But just one comment, because I've heard DIFC and DFSA mentioned a couple of times, and we are based in DIFC. Positively, what we have seen is that over the last year, they've strengthened their team on the insurance side. They've got more people joining them, and I think they just sat last week or last month, the head of the supervision for insurance also joining, a new person was joined from EOPA. So DIFC is doing their bit on the plus DFSA, but I think what we have to acknowledge is, like a lot of things in UAE and Dubai, post-COVID, there's been an explosion and growth in the DIFC entities as well. So I think that is where they're still playing a bit of a catch-up to resource up to make sure supervision happens. Having said that, I think DIFC is a great platform which has allowed us in this region to really grow for a lot of other, not only the insurance business. I think you have the banking business, private banking business, private credit business. So there is a lot of advantages. Yes, the team and the size should be proportional.
Yeah, I have a question for the data sharing. We understood from the discussion that there are concerns for the data sharing, that insurance company and the insured both are on the receiving end, and insurance companies struggling that, okay, like how to compare the overall data. So if the insurance company would invest on their system that they can take a direct download from the regulator portal rather than being only dependent on the TPS side, so they can, then insurance company can transparently review and compare both of the data, what is being downloaded from the portal and what is being shared by the TPA. And second query for the insured point of view, as I understood from Mr. Parvaiz, that explanation of benefit is being shared, EOB, to the customers in US market. So if we take an example of the UAE market, if the similar data is being shared to the insured, so what would be the viewpoint that the same insured would run to the market asking for a discount, where the insured doesn't know that how the price is equitably charged against that concept of if you may fall sick by next year. But this customer will take it as a piece of guarantee paper that, yeah, my claims are pretty low this year, and definitely the same claims pattern will reflect by next year. Thank you.
I think explanation of benefit is a tool which gives the transparency to the structure between the insurance company, insured, and the provider. And that tool does not mean that it is directly linked to your insurance cost. Your insurance cost is a function of overall cost, because in US, for example, you cannot distinguish between individual characteristics to price the product. If group goes in a loss, whichever group you are part of, then only your premium can change. Otherwise, your premium remains the same. So, for example, here there is a practice, okay, of individual experience, loss experience going bad, his premium is increased. Over there, you do that, your regulator will not allow you. But every individual insured is a part of a group. So every individual gets a group number. And if you are part of that group and the loss experience of that group goes bad, then only your premium can change. Similarly, if the experience of that group becomes better, then you will get the benefit of the premium. So over the period of time, I've seen a refund coming from insurance company at the end of the year, but not the charges. But I've seen refund coming. For example, as a personal example, I've seen that refund coming to me from insurance company saying that your group performed better, and the regulator has forced us to give you premium. So that's a unique. Now, question of data sharing between the insurance company and the TPA. I think it's a function of agreement between the TPA, insurance company, and the regulator. Who is the custodian of the data and who owns the data? It's my data as an insurance company. TPA is only managing my data. If there is a concern of a privacy of an individual, then the data can come without the names of individual or identifying information. And it can come as an aggregated data for the group. It can come as aggregated data for insurance provider. But I think the data custodian and the data ownership lies with the insurance company. Insurance company is the custodian of the data. Client has a right to receive that data from the TPA also. And if regulator want to aggregate that data, provide to the market, that also can be done. But that has to be done obviously without any identifiable information relating to the insured or a policyholder, to the group, to the insurance company. If they want to provide a data with the name of the providers to see which provider is costing you more when you use it, but then they have to categorize the provider. So hospital A can charge you more because hospital A has a better quality of doctors and so forth, versus hospital B, which may not have the same quality of doctor. But I think that issue has been resolved through the standardization of the cost. So I think that's my take on it.
Yeah, I'm Hassan Ali from Takaful, Oman. My question is relating to the artificial intelligence, which is the talk of the town. As CEOs of your companies, your board, what's your outlook towards the artificial intelligence? Like, are you aggressive? Because what we see from AI perspective, there are multiple applications of it, whether it's the underwriting or claim settlement, and then it come up about the regulatory and compliance as well as customer service. So a number of aspects related to artificial intelligence. How aggressive you are to welcome that change in the industry? Thank you.
Okay. First of all, I think maybe it's important that we realize that artificial intelligence is not really new. It is what we call 20 years back machine learning. So it has been there, has been used, maybe to a lesser extent by the insurance industry, unfortunately. And as you rightly mentioned, it's not only across underwriting and claims. It's even starting with your call center. Now, I don't know, for those of you living in the UAE, I am personally suffering from receiving calls, from, numbers that is actually an AI tool trying to sell me a mansion in, I don't know where, for 100 million dirhams. But it's working, right? So same applies for the insurance companies. Now, I know for a fact there are a couple of insurance companies that have already started to implement AI in their across the value chain. Of course, the priority comes for the claims part, followed by the underwriting part. But even on the operational aspect, there is there. As an example, we've just in Fidelity United implemented a couple of months back an end-to-end solution for our claims management on the motor side, up until the payment, okay, that has aspects of AI in it, and then you can take this even a notch up where it can decide on the payment of the claim. And you're absolutely right. It is the talk in the town, but the challenge that is facing the insurance companies is how to really embed it into the day-to-day operation, because you're faced with two things. One is the investment, and this is, I would say, a global dilemma, because insurance companies are steady return providers to the shareholders vis-a-vis the other players in the market. So, for example, the people that invest in Google or Facebook or Amazon, so the GAFAs of the world, they know that they don't need to get dividend on a yearly basis, because the money that they make is reinvested back into the cycle to grow the company and make it better and more future ready. The investors for the insurance companies, my shareholders, are waiting at the finish line for the yearly dividend. I need to be able to go through a challenge with them to convince them, no, we need this money to be invested back so that this company can be there in 50 years from now. Okay, so that's the first challenge that we have. The second is the resistance from our own people, and I'm just being very open about it, because whenever you say AI, it's going to take my job. So when you are trying to implement a project that has an aspect of automation, AI, rationalization, people do resist it. And I was just being very open. I was in a discussion with some of my colleagues. They were discussing an automation project, and I was very honest with them. I told them, AI will not take your job. The one who masters AI is the one who's going to take your job. So I think maybe we need to be also a bit honest with our teams, that we need to empower them to learn how to do this. Otherwise, they themselves would become obsolete. But is it coming tomorrow? Is it going to be there? 100%.
I think I just want to add something. First of all, we know that Ahmed has 100 million to buy a property. That's why AI is targeting him. On a serious note, I think, first of all, we need to distinguish between automation and AI. We see a lot of companies marketing themselves as AI expert or solution providers, but they really are more about automation. Automation has been around for a while. AI is here, and I think most of us would say that sitting over here, we never had proper AI agenda in our strategic view, I would say 2 years ago. But from now, I think everybody has, as part of their strategic planning, a proper budget, headcount, and a short to medium-term plan on how to implement AI. So that's a reality which is going to be with us. And I completely agree with what Ahmed was saying, that you have to enable your employees to work with AI. Within Munich Re, we have been having a dedicated team at the global level for the last 8 years working on data and AI. And we've developed quite a few tools around that. And what I see which is being tested out and implemented in a number of places globally, is that the three main areas where you can actually use AI. First of all is, as you mentioned, the implementation across claims and underwriting, how it brings a lot of efficiency. Secondly, within the work patterns of your employees, how you can inculcate AI and make them more efficient, better workers, more efficient workers, less number of employees to do more, better quality and more work. Thirdly is the customer journey. I think that's where AI will have a lot of impact. Customer journey, customer experience. And I think that is where we will see a lot of AI being, at the first instance in this region, you will see AI being coming into the effect. It will be more on the customer journey, customer experience. And I think for the claims and the writing and using the document, because you have multimodal information, you have documents, you have voice, you have videos, you have handwritten documents. Across all of this, there are tools which are being developed now which can be implemented. But that is going to take some time before they're actually rolled out. So I think that's where I personally see AI coming in, but it's a reality. I think we have to bring in as part of our planning now.
Hi, my name is Ahmed, and I would like to thank all of you, for the panelists, for the valuable information. Since we were talking about and discussed a lot about the MGA, and one of the esteemed participants spoke about the protection of premiums. So I just want to add and just should share the knowledge, like in terms of the DFSA, they have very strict requirements in terms of the MGA and what they could do, and the protection of the contract between the reinsurer and the MGA itself. So in certain cases, they cannot take the premiums by themselves. So, and similarly for the claims, and their role is primarily for being the experts in terms of underwriting. So this is something I just want to add. And another thing I would like to ask from the participants, since we have discussed that under the CBUA regulations, most of the regulations are coming. So how difficult and challenging it is for all of you being the leaders of the insurance companies, and how to motivate the departments in terms of complying with the new internal controls and the corporate governance requirements. Thank you.
Well, I think I've been the CEO of Emirates for 19 years, and when I first started, I would think that compliance, which really only was coming from the stock market, actually, from the forerunner of ESCA and ADX, probably took up about half an hour every couple of weeks, apart from the reporting times. And we had a very nice chap who dealt with it, but was, quite frankly, a fairly low-level employee. And now we have armies of people dealing with it. I think there's already been reference to the difficulties faced by smaller players in the market, and I'm sure that this is one of them, because their regulatory burden is the same as those of us a bit bigger, and yet they're having to do that out of a much smaller premium base. The expertise you need, we have to have risk managers now, we have to have know your customer, and all of the anti-money laundering stuff as well. Now, look, individually, I don't have a great problem, with this whole idea. I think it's an important part of the UAE growing up and maturing as an economy and as an insurance industry. So I'm not complaining about the fact that these things are coming in. But I think that the regulator is much more active than it was. I think we all know that. It has been doing it for 4 years now, but I think every year that goes by, it's more active. I'd like to see when they do consultations, but when they do consultations, I'd like to see some results from what the industry is saying back to them. I think that's an area where they could improve, and that would also include participants like BADRI as well. I'm sure you've got some good points to make. In the days of the Insurance Authority, they never did consultation, so that's certainly a step forward that they're doing some. But the days of half an hour a fortnight compliance, or being outsource it to some little company or lawyer, I think are well and truly gone now. And certainly in our case, we have a whole floor of people working on these sort of things.
You're skipping very smart of you for it. No, let's put it this way. I was planning to implement a hire freeze at my company, and the only one that got away with it was the governance part, so compliance, internal audit, risk management, as simple as that. It is a challenge, but also we should look at it as an opportunity, because we have suffered, generally speaking, because the market was composed of a number of weak players. Again, with all due respect to everyone, by the way, including my company, okay? And I think it's in the best interest of the market to be composed of maybe fewer players, but they are strong. And for you to have a strong player, you need to have a compliant player. And this is where I believe that the pressure that is there is actually needed. When I joined our company and we started building the compliance function, as it should be, you have seen all the gaps, and I'm again being very honest and straightforward. You've seen all the gaps that that have played a role into the hiccup that the company went through. When you're bridging this gap, you're actually safeguarding the future of the company. So I think it's very important to invest in this, and it should not be taken lightly. It is a burden, but you just need to swallow it, make it happen for the best interest of the company and for the market at large.
Hi, my name is Wasik. I'm from Al Bayrera Insurance. Actually, we are talking about compliance and regulation, and today highlight is MGA. But there is another regulation is going to come, and by I think February 2026, it is mandatory all insurance company has to float data to a framework, and it is open finance. So how you all CEOs can think it will be advantage or disadvantage to the company and then the market? Thank you.
Yes. Open finance, for those of you who don't know, is an initiative coming from the central bank and other parts of the government as well, and also involves banking and other financial services. And I guess at its heart is the idea that the owners of the data, in our case insureds, should have some control about where that is broadcast in order to maximize their ability to get the best terms. And certainly we as a company have been quite involved in that. I mean, it's a huge undertaking, and even bigger on the banking side. So I think there's certainly a number of practical steps which have made it a bit slower. But at least in the personal line side, I think it will be quite a big change once it's actually up and running. Quite when it's going to be up and running, of course, I couldn't tell you, but there's certainly a lot of determination to get it up and running. And all insurers will have to provide rates. I'm talking about motor now. Will have to provide rates to the system, and to some extent, you'll have to, or will have to, offer prices to every segment of the insuring public. It's not entirely clear to me at the moment about whether we'll be able to segment that in the way that we perhaps want to as underwriters. So there's quite a few important details which I think are not yet clear, but the determination to implement something here, as I say, because I think it really, the origin is in the banking system, is considerable. So if you haven't heard about it yet, it's sort of coming your way.
I think we've already exceeded the time, so I would first of all like to thank the panelists that they took the time out and shared their thoughts with us as well, and also to the audience as well for being with us, taking the time out. We've been having this conference on a regular basis, and alhamdulillah now we get a very good attendance. It's an event that a lot of people look forward to, so thank you for the support in that, and also to our team who did a lot of background work in trying to come up with the presentations and all that. With that, if you can join us for lunch, it will be just served outside, and we can end the day. Thank you.